Aviation. That's a stock in focus today. Well, time now to move to a very interesting conversation. We have a special guest joining in, Mr. Dinesh Khara, Chairman at State Bank of India. Mr. Khara, good morning. Thank you so much for taking out the time and being with us. It's always fantastic to speak with you, and we have so much ground to cover. I thought I'll talk about business growth and momentum, but then there is a bigger pressing issue, a hotter issue, if I can say, that the market is looking at today, and that's the prospects of taxation turning unfavorable for debt mutual funds. And the reason I want to start with this is that this has been a constant cry, I think, from banks, deposit mobilization. In fact, for SBI itself, while the results were fantastic in the third quarter, your deposit mobilization quarter on quarter was, I think, just under 1% or so. So your thoughts on this? There's chatter that it's actually banks who have lobbied hard to get a level playing field for fixed deposits. Your thoughts, and whether this will actually help banks if indeed we get these amendments in the finance bill today.
Good morning. I would say that, as far as this particular issue relating to the taxation for debt mutual funds, I would say that I think it must have been in line with the common thinking, which they have been having for quite some time. What should be the treatment for the capital gains? So that is something which is one of the guiding factor to my mind for having this kind of a proposition. Otherwise, I think as far as, when it comes to mutual fund versus bank deposit, these are two very different asset allocations. So I think those who want to put in their money into mutual fund, of course, it's with a very different objective they have in mind. So I think as a competing proposition, I don't think so it is competing. They may be overlapping to some extent, but overall, I would say bank deposit are a very different asset class as compared to mutual funds.
But Mr. Khara, just to follow up on that, tax was a huge instrument which led a lot of the retail investors to move away from FDs. Just because post-tax returns on some of these target maturity funds, which is simple to understand, largely investing in AAA securities, that's where the big shift of money was really happening. So you don't think that now there's going to be an advantage for banks if the taxation incentive is taken away?
No, much of it will depend upon that what is the kind of a potential yield from such kind of funds. And if at all there is a taxation also, capital taxation gains where the indexation benefits used to be available in the past, if at all they are withdrawn, what is the net yield? So I think, I think tax is one of the component which people have to be cognizant of. So they will look at the net yield post-tax, both in terms of the debt mutual fund as well as for the bank deposits as well. And to my mind, I think if at all, and also it is also a function of the risk-reward relationship, because the kind of bonds which are there in those debt mutual fund, that will also be one of the guiding factor. So I think taxation is something which one has to live with. So this will be my reaction.
Mr. Khara, good morning. Good to have you with us. Just to press on that point. So, and feel free to correct me, sir. The bank deposits in aggregate are about 215 lakh crores. Debt mutual fund AUM is about 20 lakh crores. Now, assuming that no incremental flows from the 1st of April go into debt mutual funds, assuming say 12-15% growth, what can be the incremental increase in bank deposits according to you? Can it be 1%? Can it be, will it be less than that? Will it be...
Yeah, no, see, the point is what you mentioned rightly, that 200 trillion plus is the bank deposit and about 20 trillion. Actually, 40 trillion is the total mutual fund size. So from that, that mutual fund is about 20 trillion. I'm not too sure, but whatever it may be, I don't think so that, there are certain set of people who would like to keep their funds into the debt mutual fund, irrespective of the taxation impact also. So I think whether we will have 1% gain or so, it is very difficult to predict. Perhaps maybe we'll have to wait and watch how really it makes a difference as far as the deposit climate is concerned for the banking system. But banking system deposit essentially accrue from the overall growth of the economy. This is how I look at credit, and that is one of the major catalysts.
Mr. Khara, any impact on the lending side, sir, because of this? I mean, will this lead to sort of more borrowing from banks rather than from mutual funds?
I don't think so. I don't think so, because those who go for the debt issuance, debt paper issuance, they are the one who participates in the debt capital market. That debt capital market is a very shallow market as of now. Okay. So even if I don't think so, it will have any significant impact in terms of the corporates reaching out or newer corporates coming to us. I think it will have very nominal impact, nothing very significant.
Right. This aside, Mr. Khara, how has business generally been? There's been talk of some moderation in loan growth. Have you seen that as well? And what about net interest margins? As cost of funds increase, do you think there could be some compression in order for that as well?
Well, as far as business growth is concerned, loan book, we expect that this year we should have at least about 16% kind of a growth in the loan book. And as far as deposits are concerned, they are growing at about 10% or so. For the system level as a whole, also, my information is that incremental bank credit has grown by about 15.5 trillion plus, and whereas loan book deposits have grown by about 14 trillion in the current year. So I think overall, I would say that there is a decent traction both in terms of deposit as well as loan. And what we have also started observing is that of late the capacity utilization has started improving, so which has led to availment of the working capital loans as well. So I think this augurs very well for the growth as far as the loan book is concerned. And apart from that, I think in the current year also, of course, that shows up with a lag. Last year, we had seen that there was about 20 trillion worth of fresh investment commitment as per the project today estimates. And a significant portion of that had come in from the private sector. This year, till the month of, in 9 months' time, it is about 21 trillion. But this commitment, of course, shows up with a lag. So normally we have seen that it is actually an early indicator for the investment behavior.
Mr. Khara, your term ends in October this year. Wanted to know if there is any unfinished dream, unfinished business that you have, especially with regards to another SBI unit listing. Could it be, general insurance or any other business vertical? Do you think you would do that before your term ends in October?
See, the point is that irrespective of my term, these are the assets which bank takes a call at the material and opportune time. So we will be taking appropriate call as and when the opportunity arises. So I think as of now, the markets are quite choppy. So it may not be a good time for us to list our crown jewels like that.
Okay. Mr. Khara, fair enough. I just want to go back to the loan growth point, and if you could give us some more granular color on how segments are behaving. Retail did very well for you, for instance, in the third quarter. But what we are picking up from latest commentary from corporates, at least on the retail side, for instance, car manufacturers or even housing, that there is some hesitation. I'm not saying a deferral, but some hesitation, some rethinking in terms of large ticket item purchases. I don't know if that's already beginning to show up. What is the outlook? I missed a number, the total loan growth outlook that SBI has for FY24. And within that, perhaps a view on the segment, corporate and retail.
No, we are hoping that in the next year also we should be in a position to have a loan growth of somewhere around 14% or so. And when we look at the kind of industries where this kind of a growth, it's what we have seen in the current year. Of course, we have seen it's actually quite broad-based growth which we have seen in the current year. It is in the corporate book, it is into the retail, it is into the SME book, it is also into the agricultural sector. So it is actually all pervasive. So that is something which we have seen in the current year. And I think the kind of climate which is there in terms of, the focus on manufacturing, focus on exports, that actually augurs well in terms of supporting all these core sectors of the industry. Infrastructure remains one of the major plank for growth of all the economies. So I would say that infrastructure-related core sector, then the renewable energy, which is another major focus area, EVs, batteries. So I think practically, apart from the conventional industries, we are seeing growth all across. So I think that's how we expect the situation is going to continue in the coming year too.
And no slowdown in retail also.
Yeah. I think retail, we have seen that till the month of January or so, we had seen, as far as our mortgage loans are concerned, we had seen an increase in sanctions to the extent of 24-25%. So, of course, the growth comes after taking care of the repayments. But I would say that this trend is very, very healthy trend, which we have seen.
All right, Mr. Khara, it's always such a pleasure speaking with you. Thank you very much for your time here on CNBC TV 18. Thanks indeed for being here. Well, that's the chairman at the country's largest bank explaining to us the implications of the latest changes in the debt side, debt mutual fund side, but also, business growth trajectory for the bank itself, which stays pretty solid. We'll take a quick break here. We have Pramod Amte of Incred Equities who will join in to put the focus on the latest market trends. They have a strategy note out, so we pick up on that.